So email came in from Peter, and he says, how low can Telus shares go and why? So Telus Corporation, T on the TSX, currently trading at a price of just under $22, about a $32 billion market cap, and about a 6.85% dividend yield. And the company provides a range of telecommunications and information technology products and services in Canada. And it operates through two segments: its technology solutions segment, as well as its digitally led customers experiences segment, with about 86% of its business coming from the technology solutions segment. So, since early 2022, the stock is down approximately 37%. And let's do a little digging to see why we have seen the pullback. So, looking at the last quarter, or the financials here, Q4 of 2023, revenue was up 2.8% year over year. And this was led by strong performance in its core telecom business, with the strongest Q4 customer growth on record, with a total of 404,000 net additions, which is up 34% year over year. And the company also experienced its highest mobile phone net additions since 2010, with 443,000 net new customers. Adjusted EBITDA was up 9.4% to 1.8 billion year over year, and net income to common shareholders was up 16% to 288 million, or 20 cents per share year over year. And free cash flow was up about 83% to 590 million. So fundamentally, I believe that the results have been decent. Now, looking at the balance sheet, net debt was 26.6 billion, which provides a trailing net debt to EBITDA multiple of about 3.7 times. And if we look at the same period last year, net debt was about 24.2 billion, and the net debt to EBITDA multiple was about 3.6 times. So debt has increased slightly year over year, but the weighted average interest rate in 2023 was 4.33%, up from about just 4% in fiscal year 2022. And to put this into perspective, for the 2023 year, interest paid increased by about 380 million. Now, looking at the company's guidance for fiscal year 2024, are their targets. They anticipate their technology products and services segment revenue to grow about 2 to 4%, and adjusted EBITDA to grow 5.5% to about 7.5%, and consolidated free cash flow to be about 2.3 billion, providing a forward price to free cash flow multiple of about 13.9 times. And just comparables here. So this compares to Rogers, which trades at about 9.6 times forward free cash flow, and BCE Inc. or Bell, which trades at about 13.9 times forward free cash flow. So the same as Telus here. But it is worth noting that Rogers does have significantly higher debt compared to both Telus and BCE, which is a reason for the lower price to free cash flow multiple, as it does not consider debt. And if we look a year ago, when Telus was trading in the $27 range, the stock was trading at about 20 times forward free cash flow at that time. Quickly looking at the dividend, the company has increased the dividend for 14 consecutive years, with the payout ratios generally over 100%. But if we look at any of the Canadian telecoms, including Rogers and BCE, we typically see the same thing with payout ratios of over 100%. Now, to answer Peter's question on how low Telus' shares can go and why we are seeing the drop, I think that it comes down to a few things. So, number one, increased leverage and elevated interest rates are placing pressure on the business. I think the debt is sustainable, but is certainly causing a bit of a headwind to profitability, and higher interest rates are leading to a reduction in residential and business development project work compared to 2022. Now, entering 2023, the business was trading at over 20 times forward free cash flow, which was a bit pricey. And during the year, they ended up revising their guidance lower, given headwinds facing the Telus International subsidiary, as clients began to proceed more cautiously to spend on digital transformation in the current macro environment. And these pressures continue to persist into fiscal year 2024, which even led Telus to begin to break out its own guidance for their technology solution segment, whereas before they had consolidated their revenue guidance inclusive of Telus International. So compared to 2023, growth in fiscal year 2024 is anticipated to slow on the top end. We are still anticipated to see some free cash flow growth, though. So on how low the stock can go, I really think this is anyone's guess. But given the attractive yield, the now more reasonable free cash flow multiple, and focus in 2024 on cost efficiency with restructuring investments of approximately $300 million, as well as management voicing the desire to delever its balance sheet further, I believe the stock should gain more of a footing in its current range. Now, if interest rates do come down in Canada, I think there could be an argument for the stock to potentially get some legs. But overall, for these low growth telecoms, it's more the dividend that gets us excited. And considering the yield is just shy of 7%, I think that the business is reasonably attractive. That is my piece.
Yeah, I mean, when you look at Telus, I mean, it's essential assets, right? So I don't think Telus is going to go anywhere. As you
Yeah.
said, that dividend is probably more attractive than I've ever seen Telus pay in 20 years as an income stock, and the dividend's growing on an annual basis, so that's very attractive. Now, on the other hand, that high payout ratio is not really what I want to see either. So I think if they had that payout ratio under control, I'd be jumping into this. But obviously covered by free cash flow, but not even close by earnings. So
Yeah.
or even actually the free cash flow was
It
over
was
100%.
it was still
So it
over
was
100.
covered by
That's correct.
operating cash flow. So
Correct.
it's that's kind of more or less. It really comes down to that is the main reason why we're on the sidelines from an income perspective. Otherwise, we'd be